Welcome to the deep dive video update, and I feel I should always explain the title of this. I do a number of different videos throughout the week. I do a video every day, I do a weekly video, I do an intermarket analysis video. The very last video I do is called the What to Watch video, and then I do this video, which are charts that maybe I used a little bit throughout the week, but then I stopped using them. They're not the real main focus of what's happening. And I put them together into this particular video because sometimes we have to dive a little deeper to see if we're getting some insight from these charts. Additionally, there are charts that I have that are only in this particular video, mainly for informational purposes. But to get a big picture view of what's happening with the market, we need to look at lots of different information. I use what's called the consensus approach, or looking at the weight of the evidence, putting everything together, not just relying on one or two or three bits of information. I like to look at as much information as I can, then put that together and say, okay, what is the overall picture of what's happening in the market right now? One of the videos is this particular video, and this is being prepared for Monday, June 30th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. This is an informational chart. The VIX, which is the fear gauge. When it's going up, stocks are going down. When it's going down, stocks are going up as a typical rule. And we look at this on a daily basis, and I have a number of different studies, some that are included in this video here, that deal with the VIX and the relationship, because this is a VIX which measures, it was changed a few years ago. This looks at the S&P 500, and that's the main focal point of the analysis that I do. To get an idea of what's happening in a bigger picture sense, we look at a range of the VIX, and we use a 50-period exponential moving average to do that. As a general rule, when we are below the red line or below 20, that's more positive for the market, and we can stay in that kind of a range for a longer period of time. When we go up above 20 and we're in a higher range, the market's going down and really in trouble at that point. You can see back here, when we were in a higher range, that was during the great financial crisis. Then we came up out of that, spent a number of years down in a lower range as the market was more positive, even though it went through some difficult times. Then after the COVID crash, we went up to another higher range again. And when we finally bottomed in late 2022, we started to go back down into a lower range. We started off in a higher range, and then this just kept going down, 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 down as the market was going up, 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 up. And we were coming back up here because 2025 has been very challenging for the markets. A lot of geopolitical events, earnings that were very optimistic at the beginning of the year, they've been pared back. And so the market hasn't had its exuberance that it's usually been having. Saying all of that, we're still below 20 with the long-term range of the VIX. And so we're rolling over as we've been coming up out of the lows that were set back in March, and we hit the low in April. And now we've been bouncing up from that, and we're setting new all-time highs with the S&P. And so we're rolling over with the long-term VIX here, and that is turning it back and looking more positive. This also is more short-term. This is a daily chart of the VIX here. And we use an RSI based on 9 periods to try to say, okay, what's the speed of the VIX? Because sentiment goes to extreme positive or extreme negative readings. And when we get to a really high reading here, that means there's a lot of fear in the market and we maybe are hitting some kind of a bottom. And then when we are getting very low readings with the VIX, that means the market's just going up and up and up. And folks are getting a little too exuberant about things. So we track the momentum of that and look at it using a momentum oscillator in the same way that we would use on an index or a stock or a sector. Well, right now, we're not getting any kind of an extreme reading. The VIX has been coming down as stocks have been going up, and so the VIX is continuing to go down, but we're not in an extreme negative reading right now. This tells us that, okay, from a sentiment perspective and some other sentiment gauges that we look at, that's how are people feeling. The market still has more room to go up. Now, it doesn't mean we're automatically going to go up. It just means that we're not seeing where we're extreme as far as how people are feeling about the market. When people get extreme positive or extreme negative, that's when we look at saying, okay, maybe it's time to at least look at adopting a contrarian approach. But while the VIX is going up or down and sentiment is going up or down, we tend to roll with that until it gets to an extreme reading. Then here's another study where we look at a correlation between the VIX, the fear gauge, and the S&P 500 itself. Even though this has been coming back up, we only really pay attention to this chart if we go above the dashed line. We're not there yet. Now, we were seeing a bit of heightened anxiety. We've had some major geopolitical events that happened that didn't last very long, but the market was still kind of positioning that things could get bad. And then we started to switch over and things started to appear, at least for right now, to be calm again or calmer, because they can always escalate at any time. And so we were getting a little bit of an elevated reading here, but now it's starting to come back down as the S&P's been going up. But since we never got up to the dash line, I didn't use this chart in any of the daily videos. Here's another look at a longer term range where we look at the VIX, and then there's a thing called the VVIX, which measures the volatility of the VIX. The VIX measures the volatility of the S&P 500. The VVIX measures the volatility of the VIX itself. So it's like an indicator of an indicator trying to determine the sentiment of a stock index. And we use a 50-period moving average here, and this has been going down, which tends to be more positive. This I did show a couple of times in the videos because this is the skew index. This is a variation of the VIX, where the VIX itself, wherever the S&P 500 is at, the current at-the-money option, so if we're at 600 with the VIX, it's using 600 calls and puts to calculate itself. Well, the skew index looks at maybe 605 to the upside and maybe 595 to the downside, just as an example. And when we see a lot of action in those out of the money options, either above or below current price, this skew index tends to really go up. Now, we're not quite sure if that's a good thing or a bad thing, or if it's going to be positive or negative, because you can see when we finally stop going up with the skew index and then turn and come back down, that's the spike. And sometimes that marked the top, sometimes it marked the bottom, sometimes it was a continuation of what had already been happening before. Well, we were up into this red area, then we dropped back down, then we went back up. Now we're dropping back down. And this is probably just a play by options players. And it seems to be that these were call options because you got a lot of folks that think the market's going to go up. They don't want to go out and buy the actual SPY itself. You can get into call options, which are cheaper, but they have only a limited lifespan. And you can then make money that way using options instead of putting more capital at risk. And so it's dropped down a little bit as we've been going up right now, but we get a little bit of a pullback, something geopolitical happens, we could easily go up into this red area again. But again, we don't know if that means that the market's anticipating an up move or a down move. We have to use other charts to try to give us some context with that. And this is the Ulcer Index. This was designed to be used with mutual funds because mutual funds only have one value each day, and that's calculated after the close. It's called the net asset value. And when this is going up, Ulcer, I mean, the name kind of gives away. The higher this reading is, the more stress people are having because most market participants are geared to only make money if the market goes up. And if the market is going down, people are stressing out about that, maybe developing an ulcer, and this really goes up. Well, it was really going up in April, and now it's been coming back down. And then I plot a moving average here. I only show this chart in the daily videos when we're below, when we're above the moving average. We're now below the moving average, and the moving average is actually coming down. So this shows, according to this sentiment gauge, that fear is actually decreasing. And we look at the volatility of stocks, that's the VIX, and the volatility of bonds, that's the MOVE index. And as a general rule, you see a lot of gyration along here, but typically what will happen, at least in this context where we're at right now, when the red line is coming down, that means that stocks are becoming less volatile than bonds. And so that is turning out to be more positive right now. Now, there are times when the red line goes up and the S&P is going up. So we have to look at the context of what's actually happening. It was really going up as the market was under pressure. But since we bounced up out of those April lows, the red line has been coming back down. So as long as this is continuing to go down, that's taken as more positive. And I explain this as an apples to oranges type of comparison, but really they're more related than you might think. We have the S&P 500 index itself, and there's its own advanced decline line and studies that I look at just as they apply to the S&P. Well, then we have the broader market, which is the NYSE. There's an advanced decline line for that too. And so I put them together here on this particular chart to say, okay, how is the S&P 500 doing in the context of the broader market? And you can see we're really improving. Now, the S&P has been outperforming slightly, but the NYSE just generated a golden cross, and it's starting to slip over into an uptrend now after it had been in a downtrend. We're seeing a moving average crossover with the NYSE. So the red line's going up and the S&P is going up, and they're getting a little bit closer to each other. We're not seeing a big disconnect between the two. When they get far apart, that's when I start showing this chart in the daily videos. There's a little bit of a concern just to give us information about what's happening in the overall market. But since we've been bouncing back up, this is looking positive. In fact, the moving average crossover that you see here, this is applied to the NYSE itself, the advanced decline line. This is not a moving average that's applied to the S&P 500. So this is showing that on a trending basis, this is also turning back and looking more positive. Then we look at another ratio between large caps, and those are the stocks that have really been driving the market lately. That's represented here by the Russell 1000. That's the equivalent, more or less, of the S&P 500. And then we look at the Russell 2000 index. That's probably the most popular small cap index, and do a ratio between the two. And usually when this is going up, that means that the large caps are outperforming the small caps. Well, small caps have been doing okay, but they've really been underperforming a lot. They're not looking as good technically on the charts, but we're not really seeing much of a change here with this overall ratio. We've been just chopping along sideways. When we see a general trend either going up or going down, that means one of these indexes, the Russell 1000, if it's outperforming, we're going up. If the Russell 2000 is outperforming, this ratio is going down. So we're not really getting all that much insight. We can just look at the charts and say, okay, the large caps are doing better than the small caps, even though the small caps are trying to improve. Then this came in and out of the video, and this is actually looking more negative now, where I was showing it in the daily videos when it was looking more positive. This is a 10-day average of the highs and lows for the S&P. And when we are going up, that's more positive. When we're above 50, that's positive. Well, we came up above this 90 level here, and that's a very high reading. Now, you could see that as an overbought indication. You can also say, wow, look at this, the momentum here, because this is a longer term look at the highs minus the lows. And this was showing good solid momentum, but lately it's been pulling back. We've been dropping back down under the green line. Now, if we do continue to look more positive and possibly set new all-time highs with the S&P, this is a little bit slower indicator, so it should start to turn and actually go back up. It's bouncing up a little bit right now, but to show good longer-term momentum, we want to come up to the green line and actually stay above the green line like we've done previously, and that just shows that there's consistent internal strength, excuse me, inside of the S&P 500. This is just for information, just on a percentage basis, where are we at from previous lows that were set? Well, we hit a major low in October 2022, and then as of Friday's close, we're up 76.65% from that low. And then we were coming back up, and then the market started to go back down again. We hit another significant low in October 2023. And since we've been going up from that time, we're up 50.42% from that low. And then we really took a dive here back in March and into April. And we finally hit the low here back in early April, and now we've been bouncing back up. We've gone a round trip here. We were up here setting an all-time high back in February. Then we tanked. We set the low April 7th, April 8th, April 7th here. And then we bounced back up. We recaptured all of what was lost in this downward move. This is when the trade wars were starting to pick up, and there's a lot of fear about tariffs, and nobody's really sure what's going to happen with all that. And so everything started to tank. And so far, things are looking better from an economic perspective. So we've been coming back up, and we're up 27.67% from that April 7th low. So it was a scary time in here. And if you do play the downside of the market, you could have made some really serious money here. We set a low right here at some longer term support, and then so far I've been bouncing up off of that. And we want to keep an idea in mind of how far are we either above or below the 200-day simple moving average. Right now we're 5.89% above the 200-day moving average. And we were negative because we dropped below the 200-day moving average when things were going down, but now we've been really improving. Now, we're still kind of far away from that, but when we start to get up to being about 10% or more away from the 200-day moving average, that might mean that we're starting to look a little bit overextended. So we'll keep an eye on this. Now, we're going to have to climb another 4 or 5% to get to that level, but for right now, this is more for informational purposes. If we start getting far away from here, then I'll start using this chart in the daily videos, but it could still take quite a bit of time to get there, if we even get there in the near future. All right, then these are anchored moving averages. These are different than regular moving averages, where if you have a 10-period moving average, and it's a simple moving average, that means you take all 10 periods, you add them up and divide by 10. And then the day number 1 gets as much weight in the moving average as day number 10. Then a variation of that is the exponential moving average, where instead of day 1 having all the weight in the calculation, maybe day 8 or 9 get more weight in the overall calculation. Well, the anchored moving average, it looks at a current either high or low and then projects that moving average forward. It's a little different way of using this. Well, we're above all of the plotted anchored moving averages here, going back to major lows. I had one going back to the high that was set in February. And since we're above all these lines, there's really been no need to show them. Where this will come in handy is if we start to pull back. This provides us with a lot of different areas of possible support if we do start to see some weakness coming into the market. Then we want to keep an eye on different ratios between growth versus value. And we're seeing some improvement, but there's a lot of different ways that we can measure that. We look at growth versus value, and I go through that in the intermarket analysis video. Well, we can look at different industries with each other, and one of them is discretionary to staples. Now, the very top chart, that's a weighted chart. That means that stocks like Amazon and Tesla, which make up the biggest part of discretionary, if they're having good or bad days, then that influences the discretionary sector a lot more. Well, you can see the ratio between the two. We are improving, but this has been one of the weaker areas of the market. If you go back to August of 2024, pretty much through the end of the year, discretionary, now this is the ratio, but just looking at the discretionary sector by itself, it was the best performing area of the market. Well, then it kind of topped out and has been giving us some problems ever since then. It's been bouncing up with everything else, but it's not really performing all that well. Now, it had a pretty good week this last week, but to be even more positive, we want to see this ratio continue to go up. Now, to be a little bit more fair, this is a version of what I show in every daily video, the equal weight version of discretionary to staples, where Tesla and Amazon don't have as much of an impact. Everything is treated the same there, This is also improving, but still lagging nonetheless. So we're seeing a bit of a confirmation between the weighted and equal weighted version of this study. But the fact that it's going up is considered to be more positive. Then we look at the tech sector, which is growth, and utilities, which typically are they're seen as defensive. You could make a case that utilities are growth because of the this huge need that is there for electricity with AI and electric vehicles and cryptocurrency mining and all of that. But as a general rule, when this is going up, that means that growth is outperforming value. And that's what happens in a more positive environment. When we were really coming down, we saw this ratio going down. Now that we're going back up, we're seeing this ratio going up. And we look at biotech, which is a growth area in the healthcare area itself, where biotech is considered growth, healthcare is considered defensive. So when this ratio is going up, even though it's kind of going sideways right now, that's more positive for the market. And then hotels, that's considered discretionary. You don't have to stay in a hotel. You can sleep in a tent, you can sleep in your car, you can drive home, where you have some choices when it comes to hotels. So you can use your own discretion to decide if you want to stay there or not. Where utilities, you got to have those. You got to have electricity. So when this ratio is going up, that means growth is outperforming value that way. And not really breaking out yet, but still improving. Now, a couple of different ways that we can look at this saying, well, I'm not seeing any real strength right now. There's a little bit here. That also tells us that maybe this upward move, just maybe, this is pure speculation. Maybe this up move is just kind of getting started right now. We're kind of at the beginning stages here after spending a number of weeks really going sideways with the indexes and consolidating and getting geopolitical things that were happening. The market really wasn't doing all that much. It had an upward bias and it remained positive, and all of the consolidation that was happening was above the 20-day moving average. But this just shows that maybe there's more room to run to the outside, upside here. Now, at the same time, you could look at this chart and go, wait a minute, we're not really seeing a lot of strength in these areas. They are improving. What if they turn and start to go down? So you have to keep in mind that both scenarios are always at play. All right, then we look at what are called bellwethers. These are the real foundational areas of the U.S. economy. And semiconductors, they're doing pretty good, and they've been really coming up. We're just about ready to see some golden crosses with the semiconductor charts that we look at. And that's a real big area as far as growth is concerned. So we want this to do well. Home builders, they started to fall apart going into the end of 2024 and then just carried that over into 2025. This is a very interest rate sensitive area of the market. And even though they're improving and they're coming back to these previous levels here, they're not showing a lot of strength at this time. Transport's been very frustrating. They've been going down with everything else, pretty much going sideways. Could begin getting ready to break out here. We'll keep watching this chart. I look at this chart every day, and if things are really developing, then I'll use this chart in the daily video. Retail, huge part of the U.S. economy, kind of going along sideways here, but not falling apart either. And then the regional banks, Silicon Valley Bank, Republic Bank, New York Community Bank. This is still holding up for right now and actually showing some improvement because most people probably bank at these smaller regional type banks. So the chart is looking positive, not showing an awful lot of strength, but just like the previous chart, we could just be getting going to the upside. Or you could turn that around and look at it negative, saying, well, I'm not seeing a lot of strength being confirmed right here. Maybe that's more negative for the market. All right, then we look at momentum stocks, which tend to hold up better when the market's going down because these are stocks that are exhibiting good momentum. They've been starting to go sideways and actually declining as the S&P's been going up. If you notice, if you remember back to late March and early April, the S&P was really going down. This was actually going up. So these were stocks that were benefiting from being more defensive and actually holding up better. And then as we started to bounce up out of that, the momentum started to pick back up. But now as we got into the early part of June, there's probably some shifting going on with what is the current momentum. And so this has been going sideways a little bit lately. US versus international stocks, going back to the beginning of 2025, and I brought up an interesting chart that I go over in the intermarket analysis video. And I also did it in the daily video this past week, where if you look at growth of value in the US, growth is outperforming. But if you look at value to growth, the rest of the globe has been outperforming. Well, that was one of the reasons why, because the US stock market is geared more towards growth. You know, Nvidia, Apple, Microsoft, the big growth stocks. People want to buy those low and sell them high, or buy them at one price and sell them at a higher price. And so, since the US market was repositioned differently at the beginning of the year, we started to see some real weakness. And when this is going down, that means US stocks are underperforming international stocks. We finally bottomed and we've been coming up. We haven't really shifted to this going up yet, but we're going sideways, which is an improvement over the decline that we had been seeing. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Then technical alerts are put out by stockcharts.com. I go through them in every daily video, but this shows all of the alerts for the entire week. If we have more of a down day or things are more negative, we see a lot of red. If we have an up day, like we saw later in the week, both Thursday and Friday, we're seeing an awful lot of blue or green here. And you can just kind of look at this and from a color perspective say, oh, okay, things are looking positive, things are looking more negative. And it was later in the week when we saw a much improved price action with the S&P 500, and that's being reflected in these different alerts. Then I go through and I look at 6 different indexes, with the S&P 500 being the main focal point. But what indexes are doing the best right now on a scale of 0 to 100? In first place, which is quite often in first place when the market is more positive, are the QQQs. Now, it's not coming in with all that strong of a score right now. When this is really strong, we're up into the high 80s, low 90s with this score. And we actually went down a little bit. Even though we set a new all-time high in Friday's session, this actually declined down. It was giving us a bit of a higher reading, closer to 80. But still, this is the best looking index right now. And then in second place is the NASDAQ Composite coming in at 72. Now again, looking at the Qs and this, does this mean that we're seeing some weakness here? Or does this just mean we're getting going, or we're getting set up before we do get ready to actually break out and look higher? Because the first part of July, typically seasonally anyway, is positive for the NASDAQ, which means the NASDAQ 100, which could also bleed over into the S&P 500 itself. But second place is the NASDAQ itself at 72. Then in third place, which is a mixture of growth versus value, is the S&P 500 at 65.9. Then we have the Dow, which really, it had a couple of good earnings reports this past week, and it's improving. It was really not looking all that good, but now it's coming in at 54.1, which is not a great score. Above 50 is leaning more positive. But again, when this chart is up in the high 80s, low 90s, that's when we're seeing some real technical analysis strength. Mid caps improving, but still lagging behind, coming in at 24.5. And then in last place, continue to be the small caps. Even though they've been improving from a technical analysis perspective, they're still not looking all that positive. But we were getting down into the single digits not too long ago. So this is really an improvement over what we were seeing before. Then I have a short-term rainbow chart. Sometimes I show this in different videos throughout the week, the daily video and the what to watch video. But this just plots some different moving averages. Very short term, 10 periods up to 50 periods. And I changed the color so it looks kind of cool and you go, ooh, ah. But this, we can actually get some insight by just looking at this rainbow here. And this is looking pretty positive. We're above all the lines in the rainbow. We're starting to really show some more conviction, breaking out to the upside. And all of the lines are starting to flatten out and go up. That just shows that the short-term trend continues to be strong. And I haven't been showing the 20-period simple or exponential moving average in the last few videos. When we were going sideways to down here, And this is more encouraging for the market. A lot of the consolidation, a lot of this was taking place above the 20 period simple and exponential moving average here. And then we bounced up off of that and we're getting kind of far away from it. So there's been no need to show this. I have another chart where I show the 20, 50, 100, and 200 period moving averages all on one chart. Then we look at the advanced decline ratio on a short-term basis, and I do show the based on price in every daily chart, and we're above zero, and that's positive. What doesn't show up on that other chart I see here, this is looking at the volume itself, and we're above zero and advancing, so this is looking positive. And then this is an indicator I created myself a long time ago for a trading system. I don't do the trading system anymore, but I kept the indicator. Very simply, this is a simple moving average of the open, high, low, close over 20 periods. And this creates its own little mini rainbow that we see here. And when we were going up and then pulling back, areas of this rainbow were acting as general support. We came back down, came further into the rainbow, but then we're able to bounce up out of that. And if we look at the direction of the rainbow itself, and it's going up and prices above the rainbow, so this is looking more positive. And since we're far away from the rainbow, I've stopped showing this in the daily videos. We have another rainbow here from 50 periods up to 100 periods. This held up better because that move down and the bounce back up happened fairly quickly. And so we've been able to get back above the rainbow, going up, and now all of the lines are starting to go back up as we're seeing more of an improvement in the intermediate term. Then here's a 50 period moving average study, and we never did get back down to the 50 periods. So I haven't been showing this chart for quite a while, but so that's why I included it in this particular video. And then a 100 period moving average study, also still far away from that. So there's been no need to show this chart. Then this is just an eyeball percentage measurement of the low that was set back in 2023, and then we match it up here to Friday's close. This has us up 33.41%. But again, I eyeball this. You move these lines just the teeny tiniest little bit, and the whole percentage amount changes. So don't take that as anything gospel. Then when we do start to see pullbacks, we start looking at what's the percentage here. Now, a year ago, back in 2024, we were going up and then we had almost a 10% correction. That is the line between a correction or just a pullback and a correction. And the smart money came in and started to buy and took us up out of that. We had kind of a little bit of a pullback here in 2024, but then we were measuring things here. We set the high in early 2025. On an intraday basis, we were down over 21%. Now, the market generally uses closing values, and we were getting close to being down 20% from the high. And that would, if we end up being greater than 20%, then that's considered to be a bear market. We hit some really long-term solid support down here, bounced up out of that as we were getting close to that 20% decline level, and that's when we started to bounce up out of the low. So we keep an eye on not only the advances, but also the declines on this chart. And Connor's RSI, very similar to a regular RSI. We look for extreme positive or negative readings. We're above the midpoint, so that's positive, but we're not getting an extreme reading right now. Standard deviation, we're starting to pick up a little bit here, but I only show this chart when we're above the moving average. This doesn't measure direction, this measures speed, whether we're going up or down quickly. And you can see we were going down very fast back in March and into April, and so the standard deviation was just going through the roof. And then as we started to come back up, we were still getting high readings here, but then as we leveled off and were not trending there for quite some time, the standard deviation was really dropping down. Well, now that we're starting to break out and set a new all-time high, the standard deviation is starting to pick up again. Then we want to keep an eye on the S&P 100, which is leading on a ratio basis, the S&P 500. So we're not really seeing anything all that concerning with this chart. The mass index, we're far away from the blue line and the red dashed line, so nothing there. Now we are getting close on the weekly side. We'll have to see if that ends up meaning anything. Praying bottom fisher did try to generate a buy signal back in early June, but that fizzled out, and now we're below the red line and declining. So there's no signal being generated by this chart. Then another long-term rainbow going from 50 periods up to 250 periods. We did come down, drop below the rainbow, but then we came back up quickly, and so the lines were starting to roll over. but now we're back above all the lines, so now they're starting to turn back up. So this is showing that the long-term trend is trying to repair the damage that was done. And we look at a long-term special K. This is a very long-term oscillator. In fact, I just mentioned it in the daily video. I only show the chart in this video because we only get, maybe we didn't get any signals in 2024. A signal is when we go above or below the red line. Well, we did cross down below it back in March when we were looking more negative, and this is still negative overall. Now, the weekly chart is positive, and that's even longer term. And the red line is still kind of coming down here. If we start to go up and show a little bit more strength, we'll want to eventually see this special K turn back up and eventually cross above the red line. And then we look at a weekly chart of the S&P and then a weekly chart of the German DAX. That's the biggest stock market in the EU. And that's really been outperforming in 2025. We're seeing it adjust a little bit now, where the German DAX is coming off of recent all-time highs, where now we have the S&P setting a new all-time high. And then we look at the correlation between the two, and this is starting to get stronger again. As the German DAX was going up and the S&P was going down, we were seeing a real deterioration of this correlation. Now they're starting to come back more in line with each other. And this is called the Ichimoku cloud. Sometimes I refer to it as the itchy and scratchy cloud. But this is really just a set of moving averages applied to current price and then shifted forward. Heavily used when if you trade in the Forex market, but we can also use it here in the stock market. And if we're above the cloud and we see a green cloud going off into the future, that tends to be more positive. And then it also has some trending lines here. There's a green line, which goes up, and that's the fastest one. That's positive because it's going up. More intermediate term is the blue line. And we notice that the blue line is above the green line. And then longer term is the red line, and the blue line's above the red line, and all three are going up, and we're above the cloud. So this is showing that things are looking more positive. Then we look at the VIX for the S&P 500. Well, there's a thing called the Vixen. Gotta love that name. That's the volatility measure for the NASDAQ 100. I don't use this an awful lot because you can see it looks like icicles falling off of the side of a house here. But if anything, I look more at the line chart. And as we've been going up with the NASDAQ 100, and it set multiple new all-time highs and just generated a golden cross. And so seeing the Vixen actually going down is not really a surprise. And we look at the S&P on top, and then we attempt to do a growth to value ratio here. Growth being the QQQs, diamonds being value, even though there are value stocks that make up the Dow. And then we look at the correlation, and it's starting to get stronger here. And that's actually more positive. When we see the S&P going up, we see growth outperforming value and the correlation getting stronger. That's typically more positive. We keep an eye on the transports versus the Dow, and the transports are the red line here. And they've been improving, but they've been range bound for quite some time. They also have previous levels and previous highs to try to get back to. And it's been underperforming the Dow typically, but I keep a close eye on this. And if we see them more in lockstep with each other, they're still showing that transports are underperforming. That would be more positive for the broader market. The bank ETF, which has been chopping above and below its 200-day moving average, it is in a downtrend since the blue line's below the red line. But we were able to clear the 200-day moving average. And that's good. We like that. That's positive. We want the financial sector to be doing well. That just means the banks are doing well, and the banks are improving, but they also have some damage that still has to be repaired. Then we look at regional banks again. These are the smaller banks, and compare them with the financial sector. Not really seeing anything. Still in a downtrend, and the regional banks are continuing to underperform. Where we took a real big dive here, this was when Silicon Valley Bank and Republic Bank were, they're having problems. And then we were starting to come back up, and then New York Community Bank came out with some bad news, and we took a dive with this ratio again. We were just going down with the market here earlier in 2025, but we're not really seeing any relative strength with this chart, but we're not seeing any additional weakness either. Then keeping an eye on retail, as I said earlier, a real huge part of the overall economy. And this is a ratio between the S&P and retail, and this continues to go down, which means retail's underperforming the S&P. But then we look at retail by itself, and it's improving. We're above both of the moving averages. We're above the green line, which is the 200-day moving average. The longer we stay above this, the more we might see a golden cross here with the shorter term moving average actually crossing above. And then we look down below, we see that the RSI is still above 50. So it's not like retail's falling apart, but it's not showing any real strong growth either. And then we look at a ratio between energy and the 10-year bond yield here. And when this was going up back in 2021, this is energy outperforming. And we were seeing this start to develop. And then we went into the bear market in 2022. This ratio kept going up as the S&P was going down. And then finally in 2023, we've been going sideways here, just a little bit of a drift up, a little bit of a drift down. We have been drifting down lately, and then energy took off and had its good 2 or 3 days there. And now it's been pulling back as well, and interest rates have been coming down. So we're not really seeing any real conviction from this particular chart, but it's still a good idea to keep an eye on this. Then we look at gold to the S&P. We came right up to this downward sloping trend line. That's where we topped out, and we've been coming down. And gold is still the best performing asset in 2025, but it's been giving back some of those gains. And the S&P is now starting to go up. And when the S&P is outperforming gold, that's when we see this ratio going down. Then emerging markets, which still continue to underperform developed markets, they're starting to even out a little bit here. Emerging markets are in an uptrend, but on a relative basis, they're improving, but not necessarily massively outperforming more developed markets like in the US and in Western Europe. Then this is a strange one. We look at the 10-year yield in the US, we subtract the 10-year yield in Germany, and then we plot the US dollar index, and a lot of times you can see there's a pretty high correlation between the top chart and the middle chart. We're not seeing that right now. The dollar's just getting hammered. Interest rates are actually holding up better than the dollar is, and that's why we're seeing the correlation coming down right now. German DAX came up, set a new all-time high, fell back to its 50-day moving average, and for the time being is bouncing up off of that, but not back at an all-time high. Then we look at a ratio between US stocks and German stocks. When this is going down, that means German stocks were outperforming. Then we saw the big bounce up, then it came back down. Typically, we are improving here. When this ratio is going up, that means US stocks are outperforming German stocks, but German stocks are doing really well also. Then the QQQs, this kind of came in and out of the videos this week. We're above all the moving averages. I brought it up when we started to see a golden cross here. This is the ETF for the NASDAQ 100, and we're above all of these lines, and the lines are starting to go back up, so that's looking more positive. And this is just for information, very long-term, rate of change. Friday's close, then we go back 250 trading days ago and then measure the difference between the two. When we're above zero, that means we're more positive longer term. And we're above the midpoint here. This is also 250 periods, but it goes back to 1980. And this is holding up. This just shows longer term the market is hanging in there. Then this is kind of some areas that we look at to see, okay, you can watch YouTube videos, you can read newsletters, you can listen to people, listen to the media, whatever you want. And there's all this, oh, inflation, terrible, this can be awful. Well, that's okay. But what we want to do is, what's the market telling us about inflation concerns? That's really what we have to go off of here. And I have a number of different charts that look at different ratios that try to give us an idea. Is the market concerned about inflation or not really concerned about inflation? The first chart is looking at cash, which is the 1 to 3 month T-bill. Then we look at 3 to 7 year bonds. When this ratio is going up, that usually means the market's more concerned about inflation. That means cash is outperforming 3 to 7 year bonds. But this ratio is going down now. And so the context is here that the market isn't, in a short-term perspective, the market's not really concerned about inflation. Then we look at some different instruments here. We look at TIPS, which are Treasury Inflation Protected Securities. These are the instruments that people get into when they are worried about inflation and interest rates going up, because they're shorter term and they adjust for interest rates. So when this is really going up, folks are favoring TIPS. When this ratio is going down, folks are favoring 3 to 7 year bonds, which have the same, once you get into a bond, you have the same interest rate. So when you finally get into that bond, you want to lock in that interest rate, hoping that it's going to last for 3 to 7 years for you. Well, when this ratio is going down, which is what's happening right now, that means that tips are not being favored. And so the takeaway from this is that the market isn't really concerned about inflation right now. Then we use different time frames here. We look at tips with 7 to 10 year bonds. This ratio is also going down. So the market, at least the market's telling us it's not really worried about inflation. Then we look at the S&P 500 here in red and the long-term bond, which has been improving a little bit. So we're seeing the longer-term correlation pick up and the shorter-term correlation getting a little bit stronger, as bond and stock prices have typically been moving in the same direction lately. Interest rates going down, stocks going up. When interest rates are going down, that means bond prices are going up. And pretty much seeing that same thing, a bit of a strengthening here with the long-term correlation when we look at the Qs, which have been going up, setting new all-time highs, seeing a general improvement here with the long-term bond this way. So that's why the correlation is getting a little bit stronger. And we keep an eye on the 2 year Treasury yield. This is shorter term. The takeaway from this is what we've been seeing for a while, a series of lower highs and lower lows as interest rates in the short term have been dropping down. And we want to keep an eye on the different yield curves. This yield curve is looking fine, and this is what most people follow. It's a 10-year to 2 year. It's the spread between the two. We had gone inverted, and now we're back to not being inverted, and this is continuing to go up, showing a slight steepening of the yield curve. This chart's fine. Where we're getting a little bit of a concern is when we look at the 10-year to the 3 month yield curve. This keeps flirting with going inverted, not being inverted, going inverted again. And this, most folks don't look at this chart, but it's worth looking at. So when we start to go inverted and then no longer are inverted, that's usually when we start the countdown to see if we're going to go into a recession. Well, we've been just kind of dancing around the zero level here for quite some time. So we'll just keep an eye on that one. And then this is another apples to oranges comparison. We look at Eurozone stocks and compare them with American bonds. And this just shows that European stocks are outperforming American bonds based on price. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then I have a number of things called possible positive scenarios. Now, I do have another study that I show pretty much every day in the daily videos, the percent of stocks in the S&P that are above their 200-day simple moving average. And this helps us keep an eye on the long-term moving average and how many stocks are above or below the 200-day moving average. When we're above 50, that's more positive. Now, when we really get screaming to the upside or downside, that's when we use this like an oscillator for an extreme positive or negative reading. We're not getting that right now, so I haven't been showing this chart, but we are above 50. But we get this information from a different chart, so there's been no need to show this chart in the videos. That same basic approach is used to say, okay, how many stocks in the S&P are above their 50-day moving average? That's the intermediate term. We're above 50 and improving, not looking extreme positive or negative currently. Then to get more of a broader perspective, we look at the mid caps, which are improving, but not extreme. And the small caps are also improving as well, but not an extreme reading. And this, I actually did a video on this that I posted a while back, a month or so ago, maybe 2 months ago, where we look at the SPY, which is the ETF for the S&P 500, and then staples. These are, think of toilet paper and toothpaste. Right at the end of 2021, this ratio was really going up, meaning the SPY was outperforming staples. The market was more offensive then, on offense. Then we started to roll over and come down with this ratio. The market was turning more defensive. Even though we set the new all-time high back then in early 2022, this ratio started to break down in late 2021. And then we went into the bear market and we finally bottomed in October 2022. And then we started to come up and show some improvement with this overall ratio as the market was starting to go up again. Well, We topped out in early 2025, and then this ratio just took a dump here and was really going down. And I was watching this chart, and these are one of the things that we want to keep an eye on when the market is becoming more defensive or getting ready to go into a bear market. And it looked like that was happening. But then we finally hit that bottom in early April, and we bounced up out of that. And since that time, this ratio has been coming back up. It's not back to its previous all-time high, but it's breaking out above the rainbow and really showing some improvement here as the market has been turning more offensive rather than getting more defensive. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.